Professor Sotkamp here. We're going to take a few minutes to look at an example of inventory accounting. We're going to use our focus company, Under Armour, and we're going to go through what they say in their most recent annual report about inventory. Then we're going to walk through some examples regarding how inventory accounting can be done and the different ways companies can do it.
So we're going to take a look at Under Armour's 2019 annual report. Specifically, we're going to be looking at the different places within the annual report where they talk about inventory. On page 5, they talk about inventory management. And it says inventory management is important to the financial condition and operating results of our business. We manage our inventory levels based on existing orders, anticipated sales, and the rapid delivery requirements of our customers. Our inventory strategy is focused on continuing to meet consumer demand while improving our inventory efficiency over the long term by putting systems and processes in place to improve our inventory management. These systems and processes, including our global operating and financial reporting information technology system, are designed to improve our forecasting and supply planning capabilities. In addition to systems and processes, key areas of focus that we believe will enhance inventory performance are added discipline around the purchasing of product, production lead time, reduction, and better planning and execution in selling of excess inventory through our factory, house, stores, and other liquidation channels. They go on to say that our practice and the general practice in the apparel, footwear, and accessory industries is to offer retail customers the right to return defective or improperly shipped merchandise. As it relates to new product introductions, which can often require large initial launch shipments, we commence production before receiving orders for those products from time to time. Page 29, they give us a table in which we see some details related to inventories over the past few years. So these numbers are in thousands, and so if we look at December 31st, 2015, inventories were 783,031,000. They went up to 900 million at the end of 2016, up to 1.1 billion at the end of 2017. They came down a little bit by the end of 2018 and down even more by the end of 2019. On page 32, they say cost of goods sold consists primarily of product costs, inbound freight and duty costs, outbound freight costs, handling costs to make products floor-ready to customer specifications, royalty payments to endorsers based on a predetermined percentage of sales of selected products, and write-downs for inventory obsolescence. The fabrics in many of our products are made primarily from petroleum-based synthetic materials. Therefore, our product costs, as well as our inbound and outbound freight costs, could be affected by long-term pricing trends of oil. In general, as a percentage of net revenues, we expect cost of goods sold associated with our apparel and accessories to be lower than that of our footwear. A limited portion of cost of goods sold is associated with license and connected fitness revenues. We include outbound freight costs associated with shipping goods to customers as cost of goods sold. However, we include the majority of outbound handling costs as a component of selling general and administrative expenses. As a result, our gross profit may not be comparable to that of other companies that include outbound handling costs in their cost of goods sold. Outbound handling costs include costs associated with preparing goods to ship to customers and certain costs to operate our distribution facilities. These costs were $81 million and $91 million and $101 million for the years ended December 31st of 2019, 18, and 17, respectively. On page 46, they talk about the valuation of inventory. It says inventories consist primarily of finished goods. Costs of finished goods inventories include all costs incurred to bring inventory to its current condition, including inbound freight, duties, and other costs. We value our inventory at standard cost, which approximates landed cost using the first in, first out method of cost determination. Net realizable value is estimated based upon assumptions made about future demand and retail market conditions. If we determine that the estimated net realizable value of our inventory is less than the carrying value of such inventory, we record a charge to cost of goods sold to reflect the lower of cost or net realizable value. If actual market conditions are less favorable than those that we projected, further adjustments may be required that would increase the cost of goods sold in the period in which such a determination was made. So I read these things to you. Much of it might be a little bit over our heads at this point, but I read this to you to show you a glimpse of what we're going to be talking about in the next couple of minutes. If we look at Under Armour's balance sheet, again, these numbers are in thousands. We're just looking at the asset section here, and this is for December 31st, 2019 versus December 31st, 2018. We see inventories is listed as one of the current assets, which it is, assets that are expected to be converted into cash or used up within 1 year. And we see that at the end of 2018, they had $1,019,496,000 in inventories. 2018 to 2019, we see a change. It was $1 billion, now it's $892,258,000. And so we see here a decrease of about $127 million in their inventories. Now, if we start putting our accounting hats on and we start thinking about what we know about accounting and how these accounts function, what does it mean if the account goes down by $127 million? Inventory has an asset value, is an asset, right? It's on our balance sheet here. And if we see a decrease in the asset account for inventory, what does it mean? Well, a decrease in our inventory account means that we sold more than we purchased or manufactured, because our balance dropped from the end of last year to the end of this year. An increase in our inventory would mean that we had purchased or manufactured more than we had sold, because our inventory balance rose from the previous period instead of going down. And so we're going to talk about inventory. We're going to talk about these different terms that Under Armour used. If we go back, it talks about here, page 46, that they value their inventories at standard cost. What does that mean? Standard cost is a topic that we will cover more so when we look at managerial accounting. We also see this term first in, first out method of cost determination. What does that mean? And we also see that they're talking about net realizable value. What does that mean? So, we're going to move on and we're going to try to talk about what these terms mean and how to do some of these accounting techniques and methods. The first discussion that we need to have is on initial measurement. What do we record inventory at when we initially purchase it? In order to follow generally accepted accounting principles, we have to follow what's called the cost principle. The cost principle says that we're going to record our inventory at cost, which means any cost that we incur to acquire it or get it into a condition, if you can spell, a condition or location where we can sell it from. So there's more than just the purchase price of the items, if we're a merchandiser, that has to be considered. So that's the cost principle. Now, I was cutting up some cantaloupe earlier today, and so I thought, hey, it'd be fun if we did our example here with some cantaloupe. We just need a basic item that can be purchased and sold to discuss initial measurement. So we're going to use our cantaloupe example here. Now, we're going to assume that I had in my beginning inventory, I had some units. And the units that I had were 5. So let's do it like this. I had 5 units to start with. Okay, 5 units. Then I have to know, well, what was my cost per unit? And we're going to say my cost per unit, what I paid for these was $1.50. And then we want to know, well, then what was the total cost? How much did this stuff cost me in total? So if I had 5 and it was $1.50, then that would have cost me $7.50. So thinking about it this way, if we thought about our inventory T account, if we had an inventory T account up here in the corner, we began with $7.50 in it. Okay? Then what are we going to do? Well, we're going to probably try to sell that stuff, but we're not going to talk about sales quite yet. During the month, we'll say it's July. During the month of July, we're going to purchase some more cantaloupe, and we're going to try and sell it. So we're going to make a purchase here on July 1st. And we'll say on July 1st, we bought 10 more cantaloupes, and the price had actually gone up to $1.65. And this happens, right? The cost we incur to purchase our items fluctuates, right, from time to time. And so it's $1.65. And so that purchase cost us $16.50. We make another purchase on July 15th when we buy 6 more cantaloupe. The price by the 15th had gone up to $1.80. And that purchase would have cost us $10.80. And then we make one last purchase on July 23rd. And we purchased 9 cantaloupe that day. And those cantaloupe had actually gone up to $2 a piece. Now, I don't know if this is what cantaloupe cost, but we're just making up some numbers for our illustration. And so that purchase would have been $18. So I started the month with 5 cantaloupe, and over the course of the month, I purchased an allotment of cantaloupe 3 different times during the month. And so when I get to the end of the month, how many cantaloupe did I have in my possession during this month that I could have sold? That is what we call goods available for sale. Okay? And so if I add up all of the cantaloupe I had in my possession, I would have had 30 in total. And those 30 cantaloupe over the course of the month of July, from what I started with and what I purchased, had a total cost of $52.80. Now, what happens next is during the month of July, most likely, I sold some of these. And so we have to look at this and we have to say, okay, well, if I had 30 that I had available to sell to my customers, how many did I actually sell to my customers? And so looking at this, out of this 30, 2 things happen. We have some that were sold and some that we still have. So we're going to make up some numbers here for the illustration. And so we're going to say that we sold 18 cantaloupe during the month of July. So at the end of the month of July, if we sold 18 out of 31, or 18 out of 30, we should have left still 12 in our possession. Not too hard, not too difficult to grasp, I think, at this point, right? We started with 5 cantaloupe. We made 3 different purchases. We had a total that we could have sold of 30, and apparently here we sold 18. If we sold 18 of our 30, that means that 12 of the 30 we should still have in our inventory. The problem comes when we have to talk about dollars. Understanding the units isn't too bad, but when we try to talk about dollars, it gets a little bit more tricky. Because as those 30 were split between what was sold and what we still have, these dollars also have to get split between what we sold and what we have. Now, we know that the cost of the goods that were sold, right, is part of our income statement, right? Cost of goods sold. And the inventory that we still have, the items we still have, should be in our inventory account, which is an asset on our balance sheet. But the question becomes, which ones did we sell and what dollars should go with them? If you think about purchasing cantaloupe, and as you're buying them, even at different prices, you're putting these cantaloupe in your on your cantaloupe stand or however you're selling them, you're probably mixing them all together. And there's really no way to tell. There's no barcode on a cantaloupe, right? There's really no way to tell which ones cost which amounts. And so as we get to the end of this period and we say, well, we sold 18 cantaloupes, we need to record the sales of those 18 cantaloupes. We have to choose here which ones we're going to expense and which ones we're going to say that we still have. Now, the easiest way to do this is what's called specific identification, and that's when we know exactly which ones we sold. There are some businesses that you can do this with. If you sell custom jewelry, for example, you're going to know specifically what item you sold. If you're selling houses, you're going to know specifically which item you sold. Even large vehicles, they have specific identification numbers, but we can identify them. When we talk about other things, though, when we talk about items like cantaloupes or things that are harder to distinguish, separate, identify, it gets a little bit more tricky. And so we have these different methodologies, what are called cost flow assumptions. Cost flow assumptions are what we adopt in order to determine how much and which inventory items to expense. And there are 3 of them, and we're going to work through an example of each one. But we have 3 different cost flow assumptions. Okay, they are FIFO, LIFO, and weighted average. Now, we're specifically looking at these cost flow assumptions from a periodic inventory perspective. Periodic. It's really hard for me to make lines like this. Periodic. There we go. All right, from a periodic perspective, it makes it easier to teach the concepts, which are really the main thing that I want you all to grasp. If you're interested in learning how this works from a perpetual standpoint, I will have videos in my intermediate series on inventory that are related to perpetual, FIFO, LIFO, weighted average. But for now, we're just going to look at it from a periodic standpoint. So, looking at this, we have to say, all right, well, we sold 18 units, 18 cantaloupe. Which ones do we choose to expense for these sales? If we are going to follow FIFO, okay, I'm going to scroll down a little bit here. If we are going to follow FIFO, FIFO stands for first in, first out. If we're going to follow FIFO, we're going to count from the oldest to the newest. Okay? We're going to count from beginning inventory down through the purchases that we made. That is how we follow FIFO. Okay? And so under FIFO, we would count. We would say, all right, well, I had 5 units at $1.50, which was $7.50, so I'm going to expense those. And then I had 10 units at $1.65, and so I'm going to expense the $16.50. How many more units do I need to account for being sold? Well, here I have 15. I need 18, so I'm going to take 3 more. So I have 3 units at my July 15th purchase, which is at $1.80. And so I have a total there of $5.40. And so my total here is $29.40 for 18 units. Now, what units do I still have? Well, I still have 3 from my July 15th purchase. I have 3 units at $1.80, which is $5.40. And I have all 9 of the units from July 23rd, which was $2, so that's $18. And so I have left $23.40 for a total of 12 units. Now, that's how FIFO works. I expense the first ones in, the first ones out. So I count from oldest to newest, and I expense the ones that are oldest first. Now, when I'm doing these kinds of problems, okay, we have a way we can check our work, because these two numbers here, my ending inventory and my cost of goods sold, had better add up to what figure? They better add up to 5280, and it looks like they do. Because what am I doing? I'm essentially splitting the cost of goods available for sale, which were 30 in total. $52.80, right? I'm taking those and I am splitting it between what I sold and what I have. Okay. Well, let's look at the next one. What does LIFO look like? LIFO stands for last in, first out. So in this case, with LIFO, it's the opposite of FIFO. I'm going to start counting from the newest stuff, and I'm going to go backwards. And that's what I'm going to expense first. So I'm going to expense first the 9 at $2, or $18. I'm going to expense the 6 at $1.80, which was $10.80. And that gives me 15 units. And I need an additional 3 units, which would come from the purchase on July 1st, going backwards in time. 3 units at $1.65, which is a total of $4.95. And so if I add these up, I get 18 units, and I have a total cost of goods sold of $33.75. What do I have left? Well, I still have my beginning inventory. I still have the 5 units at $1.50, which is $7.50. I still have how many of the purchase on July 1st? I took 3 of them away and I expensed 3 of them, which means I should still have, from the July 1st, I have 7 units at $1.65, which is a total of $11.55. And so I have a total here of 12 units that I still have. And those 12 units have a cost of $19.05. Now again, I can check my work because I know that this number here and this number here have to add up to $52.80. So LIFO and FIFO are two options that companies have when it comes to determining what their cost of goods sold and ending inventory balances should be. The last method that companies have to choose from, or the next method, I should say, there are many other methods that we haven't really gotten into, we won't get into, but you may study at a future point in time. But we have weighted average, okay, which is the final method. Now, weighted average, scroll down a little bit here, weighted average works a different way, okay? When we look at weighted average says, all right, well, we're not going to count backwards or forwards. We're going to figure out what the average cost of our items was, and we're going to use that to determine our expense and what we have left in our inventory account. And so we take, to figure out the average, we'll do it over here on the side, we take the goods available for sale in dollars, which was $52.80, and we divide that by the goods available for sale in number of units, which we had 30. And so this gives us an average cost of $1.76. Okay, that's our average cost. Now, once you've identified the average cost, the rest is fairly simple. How many units did we sell? Well, we sold 18 units. Average cost, we sold 18 units. Average cost was $176, and so we would have a cost of goods sold of $31.68. How many units we still have? Well, we have 12 units still, and average cost is $176. And so our ending inventory balance should be $21.12. And so those two numbers, again, like the numbers above, should add up to give us our $52.80. Now from here, what can we do? Well, from here we can make our journal entry for cost of goods sold and inventory for our sales. These different methods is the first real chance that we get in introductory accounting to see that companies have options in terms of how they do their accounting. Up to this point, there hasn't been a lot of variation or just differences in our accounting mechanism for corporations. Now we get to see that they do have choices, and the choices companies make will affect their financial statements and their financial position and results of operation. So let's take a minute and take this illustration one step further. Let's say that we have some additional information here. That we sold those 18 cantaloupe, and our sales price for those 18 cantaloupe was $4 a piece, which means we had sales during the month of July of $72. That our operating expenses for the month of July were $23. And that our tax rate is 30%. So that's just some additional information for us. What happens when we look at the income statements that would be created under each of these different methods. So we're going to create income statement, and we're going to have one column for FIFO information, one column for LIFO information, and one column for weighted average. Now, when we build our income statement and building it in the multi-step way, we're going to start the same way for each method. The method of inventory cost flow assumption is not going to change the way we build the statement. So, first thing we're going to have is sales, right? Our sales revenue. And that, we know, is $72. Doesn't matter which method of inventory valuation we have chosen. We know that the company sold 18 cantaloupes, $4 a piece. Our sales are $72. What's going to change is what comes next. When we look at cost of goods sold, under FIFO, okay, up here, when we determine what we were going to expense, right? We know that we calculated $29.40 as the cost of goods sold. Under LIFO, we calculated $33.75, and under weighted average, we calculated $31.68. And so when we take sales and we subtract the cost of goods sold, that's what gives us our gross profit, right? And so with gross profit, what do we get for each of these methods? FIFO, we get $42.60. Under LIFO, we get $38.25. And under weighted average, we've got $40.32. So we get different gross profit figures. Why do we get different gross profit figures? It's not because of our sales. It's because of the amount we are expensing for our inventory. We got different amounts, right, under each of the three different methods. So we'll come back to that in a second. After gross profit, we take out our operating expenses. We saw that those are $23. Again, that's not going to change depending on our inventory method. Those are things like utilities and whatnot. Our inventory choice doesn't affect that. Then we get our operating income. Okay, our operating income under each of the different methods. Under FIFO, our operating income is $19.60. Under LIFO, our operating income is $15.25. Under weighted average, our operating income is $17.32. Once we have operating income, the next thing that we find, if we don't have any other revenues or expenses, is income tax. Now, we said our tax rate was 30%. So if we take 30% of our operating income for each of these, we get $5.88 for FIFO. We get $4.58 for weighted average, for LIFO, and we get $5.20 for weighted average. That allows us to find net income under each method. So our net income, if we had chosen FIFO, would be $13.72. Our net income, if we had chosen LIFO, would be $10.68. And our net income under weighted average is $12.12. So, as you see, right, we get different numbers. We get different numbers for cost of goods sold, which then gives us different gross profit figures. After we get different gross profit figures, that feeds down into operating income, which also feeds down into income tax. Okay? Now, you say, well, which one of these would I choose then? Right? The prices in our market that we're dealing with right now, if we scroll back up, the prices, right, from the beginning of the month to the end of the month, they're going up, right? And that's, typically the case with costs. They rise, right? They don't typically fall, but it depends on the industry. But in this scenario, prices are going up. Which one of these do I choose? Well, I could look at this and I could say, I got an email. I got to get back to my marker. All right. I could look at this and I could say, well, this one here, right, this is the highest. Whoa. Hang on a second. Trying to get used to this thing. I could look at this and I could say, this gives me the highest. All right, this is not cool. Bear with me. I'll try to go with the pen. Maybe that's what I was on before. Yep. This gives me the highest net income. Which typically, right, we want to look profitable, right? And the more profit, the better. Over here, I get the lowest net income. Okay? So, and my weighted average is kind of in between. It's in between on everything. So, between FIFO and LIFO, I gotta know what this difference is, right? What is the case here? Well, we see here, cost of goods sold is $29.40 under FIFO, and it's $33.75 under LIFO. So that's really what's driving the difference. Everything else that follows. Now, why is my cost of goods sold under FIFO so much lower than under LIFO? Well, as we said, prices are rising. And so under FIFO, first in, first out, the ones I expense first, right, are the cheapest ones because they're the oldest ones. So my expense here is lower. Under LIFO, I'm expensing first the ones that I just most recently purchased, which are, if prices are rising, the most expensive ones. So you can think of LIFO like a cookie jar, where the last one you put in the cookie jar on top of all the others, right, is the first one you take out. Whereas FIFO is more like a conveyor belt, right? The first one you put on it is the first one that's going to come off of it. And so we have this major difference here, and it leads to a big difference in net income. Why then do corporations choose LIFO? What is the point if prices are rising and it makes us look the worst? Well, the key difference is right here. Okay? It's right here. Now, I didn't calculate this ahead of time, so I'm going to look at this here. We have a difference in taxes of $1.30. Okay? And so if we look at this, we have a $1.30 difference. Now, that may not seem like a whole lot in terms of our example here. But if we were looking at these numbers and say they were in millions, and so it was 5.8 million and 4.5 million in terms of taxes, that would be a $1.3 million tax difference. That's a lot of money. And so corporations typically will choose LIFO for tax purposes. So even though we have the lowest net income, we have the lowest taxes. Okay, over here we have the highest net income, which also leads to the highest tax. And so we choose the method based on a couple of things. We can choose the method based upon our tax preferences. We can choose the method based upon which financial statement we care about the most. If I care most about my income statement, I might choose FIFO, if profit's the big thing for me. If I care more about my balance sheet, right, I might choose my FIFO method as well, because it's going to give me the most recent value for my inventory cost. LIFO here is a bit of a difference. Okay, it's a bit of a different kind of thing. I don't want to get too much into theory here with you, but one thing to point out that I try to stress is that no method is perfect. Okay, there's no perfect method. They all have problems. I have a lot of students that will say, well, we should use weighted average because it's the most accurate. Well, when we talk about accuracy, the only method that is truly accurate is specific identification, when we know specifically which items we sold and expense those items with the known cost associated with them. All three of these methods are assumptions. And so, with first in, first out, we don't know for a fact that the first ones we purchased are the first ones we sold. We're just using that as our mechanism. With LIFO, it's not necessarily that the most recent ones we purchased are the first ones that we sold, but that's just the mechanism that we've chosen. And so, all of the methods have problems, and they all have benefits to them. When we look at FIFO, principally we're looking at the profit being good and the balance sheet being good, which we'll talk about in a little bit. With LIFO, we're principally saying, here, if we choose this method, we actually have a better profit number. Why do we have a better profit number under LIFO if it's lower? Well, when we look at this, we see this is recent sales, right? Sales from this period. When we look at LIFO, we're saying the most recent ones we purchased are the ones we say are sold first. And so we have recent cost. We're matching recent sales and recent cost, which gives us good matching. We've talked about matching as one of those things that we desire to have. Matching is what helps us determine good profit figures. Over here, right, what do we have? Okay, over here, okay, we have, get my marker to come back. Over here, we have recent sales. But when we look at FIFO, and we're saying first in, first out, the ones we are expensing, first anyway, right, are the oldest ones. So we have old cost. Recent sales versus old cost, which doesn't actually give us a very good matching figure in terms of profits. So, all three of the methods were going to give us different answers. They're all going to give us different tax liabilities in terms of the profits that we recognize. The one that is most popular with public corporations is FIFO. LIFO is second, and weighted average is third. And so, let's go back for a second and look at Under Armour. Here's what Under Armour said on page 46 about their inventory. They said inventories consist primarily of finished goods. Costs of finished goods inventory include all costs incurred to bring inventory to its current condition, including inbound freight, duties, and other costs. Here's the point I want to emphasize here. We value our inventory at standard cost, which approximates landed cost, using the first in, first out method. So, Under Armour is a FIFO company. They use first in, first out cost flow assumption. So, we're going to end our video there. We're going to pick back up with another video on the additional valuation procedures that companies have to apply.